Hello and welcome to the week ahead with London Capital Group. Today taking a closer look at what may move and shake the financial markets in the week beginning the 2nd of November. Now the markets will be looking ahead to the RBA next week. The Reserve Bank of Australia will deliver its November interest rate decision on Tuesday. Now while some are calling for a rate cut at this month's meeting, the majority of economists are actually expecting no change. LCG analyst Ipek Ozkardeskaya discusses.
It seems that the expectations for the RBA meeting are quite mixed for next week. Some analysts expect a 25 basis point cut in its interest rate. Some others think that it's not going to happen. The consensus is an unchanged monetary policy at 2%. So at this point, the question is whether the RBA really needs to cut its rates at this week or at next week's meeting, obviously, because there is not such an emerging need, especially after the Fed went quite hawkish on its own monetary policy last week. So we are just quite interested to see what are the forecasts going to be for the RBA. And if we think about it, at the end of the day, the Australian dollar is now going to 70 cents levels, which is acceptable by the RBA. On a trade weighted basis, we can see that the Australian dollar is at 6-year low. So where is the necessity? And the RBA may prefer to keep this additional rate cut joker in hand in case the other leading central banks just play very hard on the dovish side of this central bank monetary game. So they will have some more flexibility. Obviously, the inflation figures that has been quite soft this week give this flexibility, and this is why the market is quite balanced. But we believe that it's going to be a non-event.
UK services PMI for October is due out on Wednesday, and an improvement is currently expected by the market after last month's PMI survey revealed that UK service sector growth slowed further in September to its lowest rate in almost 2.5 years. Now, with the Bank of England meeting on Thursday, the services PMI will be one to watch, as will be the pound dollar.
Well, the UK services PMI is going to be important as the UK economy is made up by 70-75% of services sector. In September, we have seen some abnormally low numbers, so we expect some recovery into this to 54.5, but still below 55. We don't believe that there is the strong recovery that we are looking at in the UK. So what's going to be important for the sterling dollar is mostly the BOE meeting and the quarterly inflation report. From the BOE meeting, we don't expect any change on the rate, so it's going to be the 0.5%, the historical low that we've been seeing since years now. But the most important is going to be who voted for what. So basically, we have seen some improvement in wages in the UK. The living wages from the Conservative government is kind of helping to push the wages across the country quite higher. Now we are talking about a possibility of cutting tax credits, which can kind of jeopardize this enthusiasm in wages growth. But still, the economic conditions in the UK may push some members in the BOE towards the hawkish camp where Ian McCafferty was sitting alone. So maybe some one or two members might join him in this hawkish camp and may opt for a rate hike. So the pound dollar has been unable to cross over the 155 mark. So we just saw a setback this week to 52.50 levels. We might see a further extension to 152, which are quite good levels for dip buying opportunities for those who are looking to strengthen their long positions in pound against the US dollar. So we might see that some recovery may take us to 155, but still it might be a quite range between 152 and 155 levels before a fresh news or fresh trigger leads to a breakout.
Finally, Ipek discusses what she thinks about this week's FOMC meeting and next week's non-farm payroll expectations, following last month's weak, disappointing reading of only 142,000 in September.
So the Fed sounded more cheerful than expected and interestingly dropped their concerns about the global economic slowdown. That has been very interesting, and they are now seeming to be focusing more on the US jobs data and the US inflation figures. We have also seen very weak GDP number from the US on the third quarter, which is normal. We have seen a strong root in the commodity and the energy market in August. So this has taken some shine out of the US GDP numbers. But if you are looking at the data dependency rhetoric of the Fed, a rate hike by December may not be possible. However, the Fed decided to keep it on the table, and the US sovereign markets give a probability of a 50% hike by December. So this is the main hawkish setting regarding the US dollar after the FOMC meeting. So next week, the NFP's non-farm payrolls is going to be very important because we will be watching the data. And last month, we had some quite strong disappointment, 142,000 jobs added only in the US economy. This month's expectations 177,000 jobs, and this is the first time since February 2014 that the expectations is lower than 200,000, which means that there is still a bit of weakness in the US jobs market, and this is why it's very much interesting to see if the market thinks that the December rate hike is still feasible or not.
Last week, Ipek gave us a technical update on the pound dollar, but this week her attention is on gold.
So we have seen gold losing gains this week, and we are now looking at 1140.35 levels. If we close below these levels next week, we might see a further setback to $11.20, $11.10 levels. However, given the uncertainties regarding the US dollar strength and the Fed and the FOMC decision to hike in December or not, the uncertainties are there, and this might be an opportunity to enter in long positions above 1100 levels in gold. However, on the upside, we see that the 200-day moving average at 1170.75 levels is going to be still a strong resistance, at least in the short term.
That's all for the week ahead. Now, don't forget the US clocks will be moving back 1 hour this weekend, so trading times for FX and CFDs will be returning to normal. Remember, you can see our website for further details of trading times. Now, join us again for the week ahead next week, but in the meantime, have a great weekend. Goodbye.